It's amazing because it's really the only real estate strategy that pays you up front, during, and after money. I don't think there's a business on earth that is as scalable as multifamily if you simply look at the numbers, force value. And so the biggest opportunity really is with people who scale in general, doesn't have to be real estate, they always ask who questions, right? It's not how do I raise money, who can help me get money, right?
If I wanted to get started investing in multifamily right now, how do you suggest I do that? Man, have I got a great guest today. If you want to be a multifamily investor, you're going to want to stay tuned to this one because I've got Michael Blank. Michael is one of the leading authorities on apartment building investing in the United States. In addition to his own investing, he's helped students purchase over 14,000 units valued around $1.5 million and is constantly searching for ways to make a difference in the lives of others. He's also the author of the best-selling book and host of the popular podcast, Financial Freedom with Real Estate Investing. Multifamily, lots going on in that market. Is it a good time to be investing in multifamily right now?
Well, it is. I just recorded a video about this exactly. It's quite a bit different than 2.5 years ago. I mean, in the spectrum of what you can do in real estate or franchise or anything like that, multifamily typically has been on the lower end of the risk spectrum. And I know that because of the kinds of loans you have always gotten from multifamily: low interest, high leverage, non-recourse, non-personally guaranteed, interest only, for example, right? So even the largest institutions consider multifamily in the lower end of the spectrum. But 2.5 years ago, we were getting historically low interest rates, historically high leverage. Therefore, all of these things increased the risk in that lower spectrum. But regardless, now within 2.5 years, it has swung completely the other side. Something that normally happens 5 to 10 years has happened in 2 years. We're now, because of what happened with the interest rates, we're now at a completely opposite side where we're getting extremely lower leverage because the lenders went, oh, that wasn't good. Very low leverage, which reduces the risk. But also the outlook for interest rates is flat to down, right? 2.5 years ago, the outlook was basically up. Everybody agreed it was up. No one knew it was going to be that much up. But now the outlook is totally different. So the main difference is 2.5 years ago, in general, we understood that prices were heading down historically. They were at a historic high. Now, however, they're down about 30–40%, right? And so the outlook now in the asset class is one where prices are generally due to go up over the short to medium term.
Yeah. Well, I just got this last night. Connect CRE, U.S. multifamily fundamentals continue to strengthen. So I think they agree with you.
Yeah, what was your thesis? I mean, I just mentioned a bunch of stuff, but what was your thesis?
So what they did is U.S. multifamily is rebounding strongly, driven by declining vacancy rates, robust absorption. This report was by CBRE. Positive net absorption reached 183,600 units in the fourth quarter of 2024, the strongest Q4 performance on record, market's third consecutive quarter where demand surpassed new completions, further narrowing the annual completions over demand gap.
So that's positive. What's not said in that article is that we had a lot of completions in 24 going into early 25 because of all the free money in COVID.
Yeah.
But if you look at the number of permits that have been pulled over the last 18 months, it's down by over 41%. Like, it's plummeted because the cost of capital is so high, developers can no longer make money, so they're not pulling permits, meaning that once this is done, it looks like absorption is already now absorbing most of what's coming out there. But once that's done, there's nothing behind it. And so I think we're going to see that in the latter part of 25, where there's nothing else coming out of the ground. Meanwhile, the demand is still strong. And while the rents of the last year have been anemic, right, because of all this new construction and also because of the giant run up in 23, I think we're going to see the rents resume their normal growth. I think it'll be above historical averages also.
Yeah, I think so. I was reading a few weeks ago, yes, like Dallas, Fort Worth area, Metroplex has like 30,000 apartments coming on the market. New York, I think, has about the same. Austin, for that size of city, has like over 10 to 15,000 coming on. So there are markets that are really flooded with construction. And so I think you're spot on. If I wanted to get started investing in multifamily right now, how do you suggest I do that?
And there's a lot of misconceptions about this whole thing, right? You're driving by, looking into this nice apartment building. I'm like, I wonder who owns that, right? It must be some kind of super rich, super advanced, probably inherited or whatever. And a lot of people, especially if they've done some investing themselves, a flip or rental, things of that nature, really consider this an advanced strategy that they should maybe get 10 years or so experience, and then they will take that experience and the money they make, and then they will quote graduate to small multifamily buildings. And that sounds logical, but it's all wrong. I call it a myth. It's actually not true at all. In fact, you don't need, while helpful, you don't actually need any real estate investing experience because you can learn how to appear experienced without actually having years of experience. And you don't need millions in the bank because you're going to use what Robert Kiyosaki talks about, other people's money. Even if you've never done it before, it's surprising the people that come into our program, they don't really necessarily think they can raise $1 million or think they can buy a $4 million building, and then they do. And it's because people have these preconceived notions. And the truth is that we can help overcome a lot with knowledge on the one hand, practice on the other. And the most important difference in single family house investing is a more of a who, not how mentality. It's really a building a team around you. And I flipped 3 dozen houses, and I didn't understand that until much later. But the who, not how mentality by the book that Dan Sullivan really talks about, stop asking how questions. Okay, how questions is if you want to play small, then you're going to try to figure out how to do everything yourself. You're going to ask how questions. People who scale in general, doesn't have to be real estate, they always ask who questions, right? It's not how do I raise money? Who can help me get money? Like, how do I get experience? No, who can help me get experience? It's a totally different mindset. And that entire thing, that entire mindset accelerates everything.
I agree. And you hit on everything I want to talk about today. So I'm like, okay, well, where do we start? Let's start with, let's say I'm newer and I've got a little bit of money put away, I haven't raised any. What investment criteria should I be looking at first and foremost?
So in multifamily, just like look at the landscape, look at
Multifamily. Yeah,
just within
just
multifamily. Okay,
multifamily.
so you've already assumed that you want to do multifamily and you're not looking at flipping or renting another house.
Right.
Right. Well, so you looked at the asset class, you like the asset class, we talked about it's a good time, the fundamentals are strong. Okay, that's good. Then the next one is obviously a market. What market are you going to go into? And you're looking for a market that's growing, but you also have a market that you can get cash flowing properties as well. Right. So that would say disqualify New York City, which is at this point probably growing again, but can't really find cash flowing properties there. So it's not a great place to go to buy cash flowing multifamily properties. So market is number one. And then number two, really, it solves everything else, is a good property manager. Again, it's a who, not how, because there's a million things that you have to figure out. Well, cool. Well, what part in the submarket? Then how do I buy correctly, right? How do I underwrite correctly? So a property manager that manages all that stuff. And then some kind of education, right? So a lot of people come in there. A lot of people don't get in all because they're like, I can't do this. But then there's some who are a little more adventurous, I would call, like maybe like I was. They're like, I can do this. I can figure this out. I flipped a house. I have a rental property. I can figure this out. Don't do that, right? It's too complex for someone just to figure out. So make sure you have someone more experienced looking over your shoulder. And with that, you're using the right language when you're talking with brokers. You have a team built around you. There's some things that you should do, and you don't have to reinvent the wheel, right? So it's like get some education, maybe get some advisor on your team. Really figure out who's that team around you. I think that's probably the biggest lesson here right now, because there's again a million things. If you try to figure out everything yourself, it'll take you a decade.
Yeah. Yeah. You've got to make sure you find the right handyman too, because that's something you're doing your property inspections. I've seen newer investors just get their ass handed to them. They go, oh, I know a little bit about construction. And then they go in and do the inspections, and then here they go. They find out, oh, there's a cracked foundation, or plumbing needs to be completely redone. They've only done part of the building. Lots of horror stories. How do I learn underwriting? Where's the best place do you think I should go to really learn underwriting?
Well, you get two things. You need two things. You need a good underwriting model, a good financial model. Number one, ours is called a syndicated deal analyzer. It's probably the most widely used analysis tool on the planet. People from all over use it. It just makes it very easy. You enter 7, 8 pieces of financial information, and it pops out a very complex financial model that helps you answer the question, what is the most I can pay for this thing and why? And the second thing is you got to make sure you're making the right assumptions. And again, that's when you lean on your team, because how else are you going to know, well, what are my rent growth assumptions? What are my occupancy assumptions? What should I use for expenses? Now, you can use rules of thumbs all day long. You can go online and research all day long, but really you need experienced people on your team to lean on. Someone like a property manager who's familiar with that particular part of town, someone like a lender who can advise you on what the loan terms are going to be, right? And so you have that combination of a good financial model and a team to lean on, and now analysis actually becomes not nearly as complex as people think, even if you're not a numbers person.
Yeah. The so one thing that we did when we were investing, so we used to invest in multifamily, had a good number of units for a while. Then we got out of those and into single tenant net lease. We'll probably get back into multifamily, get in it sometime. I just love the asset class. I think there's a lot of upside there as well. But one thing that we always had when we were starting off was kind of a quick back of the napkin numbers that we were looking at. This has been a while ago, so I'm sure there's going to be some updated numbers. What do you like? Because you can't analyze every property, right? So when you're out looking for at properties, Michael, what is your kind of quick back of the napkin criteria that you look for before you do a deep dive into an analysis? Obviously,
We use
area is
something called
one.
So that's a great question. We have something called a 10-minute offer that really allows you to do it very quickly without a very complicated financial model using the information you get from your broker. And this allows you to really give feedback to your broker very quickly and at least get in the ballpark. Typically, what happens when you get a marketing package from a broker, they usually overestimate the income and underestimate the expenses. You can use some relatively easy rules of thumb. For example, on the income side, that is going to be at least 10% economic vacancy, right? So if someone only puts in 5%, you adjust the income. Expenses typically are 50 or 55% of the income, and a lot of brokers in their marketing package use something lower, 35 or 40%. So you adjust that. Okay. And then you have an adjusted NOI. And then you take their cap rate and you apply it to the adjusted NOI and you come up with predictably a lower price. So basically, the way the conversation goes within 5 minutes, going, yeah, this is cool. I see it. Your income is a little high because you're using a 5% occupancy rate. Oh, and I noticed that your expenses are a little low also. In my experience, it's more like 55% income for buildings in that area, which I get from my property manager. That now have an adjusted NOI, and if I apply your cap rate, instead of just asking 2.5 million, I'm coming in more like 1.9. Is there any flexibility in your seller, or probably not? And then, if they never return your call or die laughing, you obviously off the mark. You have to spend any more time on it. But they might go, well, can you put something in writing? Okay. Now you're at least in the ballpark. So now it gives you permission to spend some more time and actually now call your property manager. I got a live one here. I got a verbal on an offer. I want to put an LOI in. Now I need to go a little deeper. And now you pull out that spreadsheet. But a lot of the times we waste a lot of time because of that, because the income is overstated, and the expenses are understated, and therefore we have an overinflated NOI, therefore an overinflated price.
Yeah, the you guys focus mostly on B and C properties, right?
Yes.
So you're looking for value add mostly.
I'd love it if we didn't, but normally the numbers are hard to make work on anything, which is also same in a Class A. Class A, it's tough to make the numbers work because there is really no way to force value. And so the biggest opportunity really is with Class B and Class C that have not been renovated in 15, 20 years.
Yeah. Can you kind of walk us through what you look for when you're looking for a property, how much you want to put into each unit, kind of walk us through, because I think somebody new, they you got to really be careful here when you estimate how much money you're going to put into these units. When we first started, we kind of, we'll put $5,000 into it. And then you put some carpet in there and you do some countertops. You're like, well, there's $5,000. So now what? Can you kind of walk us through what you guys do?
It's a little bit like house flips, right? So house flips is you're buying a house that doesn't look so nice, and you really want it to look like the neighbor house. Very simple. It's the same thing with apartment buildings, where typically you want to go into an area where there's same type, style, same year, age of it. It's just someone has actually taken the time to renovate it, and as a result, the place looks nicer, the units look nicer. Maybe they have some amenities like a dog park or something like that, and of course, they're getting higher rents. Well, same thing like a house flip. You want to go in there and buy an apartment that it does not look like that. Same age, it just simply does not look like, and therefore rents are $300 lower, whatever the case may be, right? And so now the trick is, well, how much do I need to pay to get those higher rents? And that's, of course, when you need a good team there that tells you, well, if I wanted to make it look like that, I'm going to need a new roof, new parking lot. I got to paint the sides. I need new counters. I need blah, blah, blah in the rooms. And that's going to cost you, $15,000 on average per unit. Okay. Now you need to have just like a house flip. You need to have a contractor that can estimate that, and then your agent tells you what the finished product needs to look like. So you need this. It's the same thing, just at a larger scale. And then you go in there and you start this renovation project, and then you need a property manager who can lease these units at the market rent. And again, the property manager is very helpful. The property manager is almost like they'll know exactly what the rents are on the market, what the amenities are typically in a market. They know that precisely. There's even software you can get that helps you actually compare that on a much more minute basis. So you know exactly if I have these finishes with these kind of amenities, I can expect roughly this kind of rent.
What software do you guys use?
There's a
You do
there's a
custom?
bunch of them.
Okay.
Yeah, yeah. There's a bunch of property managers use, and they're typically shared amongst each other. And they also within property managers, if they have any kind of units, like let's say they have 5,000 plus units, they have a lot of data in house as well. So there's a lot of different. They all do the kind of the same thing. They're sharing data amongst each other.
Now, you mentioned amenities. When you guys are putting in amenities, what are you finding you're getting the best return on? I would imagine a dog run is probably pretty popular.
Well, number one, you got to have a first impression. Number one, right?
Right.
So it's curbside appeal, just like with a house flip. Number one, and then you need a good second impression, which is typically the office, right? And then of course you need to have a good model unit. Those three. Now amenities sometimes are hard to measure because sometimes you can't get more rent for a dog park. Okay,
Right.
how do you measure it, right? It's one of those soft returns, but you look at it over together. Well, my unit looks just like the neighboring one, but the neighbor's got a grill and a dog park and a basketball court or something like that. Okay, well, if I'm a tenant, I'm looking at both that look about equal, but I got a few amenities, I might be willing to go over there first. So I'm not paying any more rent, but their occupancy is going to be a little higher. You know what I mean? So you got to make sure you're in line and really put yourself in the position of a tenant who's looking for a place and just what would kind of decisions would they make?
Yeah. Yeah, I agree. The amenities can be, especially this day and age when you've got so many people working from home. They want to have something that they can, like a dog park or if it's a gym, they can really add value and help you with your lease up. Do you guys have you ever bought a master meter, or you stay away from those?
I have, but normally the newer ones don't have that. My first building I bought was one of those things, and I don't really typically recommend them. They're
They're
really
hard.
for older properties. I don't know, before, I don't know, 1960 or something like that.
Yeah.
And they're a little more tedious.
Yeah. Yeah. You got to have the system that, breaks down all the utilities every month per unit. And then, how many people are living in the unit you can get kickback on it. So it could be something. Um, let's talk about property management a little bit because that's something that a lot of people think, oh, I'm going to just buy a property, then I'm going to have somebody else manage it. How are you vetting now you guys, do you self-manage or do you have third-party property management?
We're a third party.
Okay. How are you vetting property managers?
So the first benefit of multifamily over single family house investing is that you have a number of professional managers to choose from if you're in a large enough market. I mean, you shouldn't be, in my opinion, in a very small market for this very reason, because there might be one guy or one gal managing properties, and if they don't work out, there's no one else in sight. So it raises the risk a little bit. So within that market, you're looking for someone who has successfully managed a property similar to this. Similar means in size, for example, right? Yeah, if you're getting into 100 unit, you don't want to, you don't want to bring someone who his largest unit is 20 and vice versa. So size, but also type, traditional versus, for example, student housing or Section 8 housing. These are all specialties. And so making sure there's a fit. So with regards to size, also location, right? If you're over here and all their other houses are over here, the properties, and it's going to be a little more tedious. We made one of our property managers go from Memphis to Little Rock, and it didn't go so well because they don't have really pre-established networks there. And so they have to have some kind of scale in that market. And that's a big deal. And the rest of it really is just looking at their portfolio and getting references, and not only getting references because everybody gives you only their best references, but actually getting a list of properties they manages from them or their website and just driving them. unannounced almost, and just literally interviewing. What do they look like? What's the staff like? Are they friendly? Are they grumpy?
Mhm.
And just kind of get an impression from them. You look at their reports that you get. Are you happy with the reporting they do? The format of that, the frequency. Do you jibe with them? Can you work with them? And then you just hire them. And then you got to hold them accountable, right? You got to hold them out. They're going to come up with a plan. Here's what we're going to do first. We're going to do that. We're going to do the second. Here are our goals. Here's what we're going to do, and then see how they behave. Are they communicating well? Are they actually getting the job done, or are they not? And if they're not getting the job done, and despite addressing it with them and nothing changes, it's time to make a change. And sometimes you have to make a change. It is what it is. The benefit is it's not like when you're hiring someone, you have to train them for the job, right? You just say, hey, here are the keys. Now go do this thing. And so that makes it relatively easy to manage. So if you have a good property manager, then you have a very high quality of life. If you have a poor property manager, then things are going to get a little more stressful.
Yeah. The key thing that I heard was go to the property. And that's what, when we were buying multifamily, we were buying out of state, and 100% of the properties that we acquired were from a property manager in the area was managing it, out of state owner. That owner had only been to that property a couple times, and there was a case with one in Texas, 74 unit, where there was an on-site manager. They were billing double what she was actually getting. We found this out when we were closing. She asked, "Are you going to keep me on?" We go, "No, you're double pay. You're double the salary of everybody else in the area." She goes, "No, I'm not." And she showed us her pay stub, and we showed her what the company was billing the ownership for. So they were cooking them there. And then they had three other employees on the property. And one of them was, I think two were getting free rent, and the one guy was not even living there. That was getting rented out, and the property management was collecting that rent from them. So if you're not boots on the ground, this kind of stuff will happen. And so that was a very key point that you made there.
I don't think you have to be boots on the ground per se, but you have to be on the ground every once in a while.
Yeah,
So a
no, not
lot of
every day.
Yeah,
Yeah.
yeah. But you're right. A lot of owners, they don't ever go there. They'll go there like once a year. And
Yeah.
that's a very hands-off approach to what we call asset management. That's not actually asset management, right? So you got to really be there once a month if you're actively asset management, and you got to ask questions,
Yep.
especially on the expenses. Sometimes there are things on there that are literally mistakes, right? Because a property manager has been managing multiple properties and there's an expense on there. Like, what is that thing? I've never seen that before. And sometimes
Yeah.
it's an honest
Yeah.
mistake. Sometimes it's actually fraud.
Yeah.
So once a month you got to go by there, right? Especially in the beginning for the first 6 months. Now you might relax it once you get going, and you got trust build up, and then you got to look at the numbers, right? But the point is this: one can manage a 7,500 unit apartment complex worth 20, $30 million very much part time, right? Which this is why it allows you to build a very large portfolio of a relatively small team. So there's an advantage. But again, if some people think this is a 100% passive investment, they should probably buy money market.
Yeah, that's for damn sure. Yeah, we just would go by we go by every month. We just pop in. And there was a few times in the beginning the office wouldn't even be open. So we ended up just hiring our own team, and so we were there a lot more. But I want to move on into growing my investment. So once I've got my first maybe two properties under management, um, what are your thoughts on best strategies to grow from there? How do I get to really where I'm going to take? I want to get 40, 50 properties that I own. What are the steps?
Have you already bought some multifamily?
Yes.
Yes. Okay. So what I find a lot of people, first time property owners from multifamily, their idea of scaling is simply do another deal. So
Hmm.
what they do is they'll do a deal, and it takes a little while to stabilize. They struggle with asset management. They don't really know what will move the needle, and as a result, they struggle longer to stabilize in a property where they should, because they don't really know good asset management practices. That's obviously a lost opportunity with the deal itself, not recognized, not raising rents fast enough or controlling expenses. On the deal itself is a lost opportunity that they will lose through cash flow and equity that they're building. But worse, a lot of people get so mired in asset management, sometimes up to a year, and they can never have the time to buy that second deal or to raise more capital. And so the whole engine kind of grinds to a halt. So a lot of early people, they struggle with this. There's this ebb and flow of getting a deal, taking time, and then only coming out of it when they're done, and they kind of go, "Whew, I'm glad that's done. Okay, let's do another deal." And now 9 months has gone by, and so as a result, they really don't scale the way they should scale if they were more intentional about planning and execution. And that's the biggest problem I find with new syndicators is there's very poor planning and very poor execution. So planning meaning that if I've done a first deal, now typically people who did a first deal, they're like, oh, it's cool. I didn't think I could do that. Right. But once you've proven that you can do it, and you probably have a pipeline of your second and third deal within sight, you have to start thinking about scale. Okay. And this is where a lot of new syndicators fall down. They don't really think about scale. They just think they're just going to repeat what they did last month, and they miss a lot of opportunity. So, what I mean by that is really sitting down and figuring out what's really possible in this business. If I actually approach this as a business and not as a side gig, okay, what's actually possible, right? So, for every $1 million of real estate I buy, I generate $30,000 of acquisition fees. So, that's a lot, right? So if I buy $10 million of real estate, that's $300,000 in acquisition fees. That does not include asset management fees, cash flow distributions, and the profit at the end. So if I do a spreadsheet, and let's say I'm buying $2 million of real estate 1 year, then the next year I could probably buy three, right? And if I can buy three, then in third year I can probably buy five, right? So you can start projecting, just okay, five, I go to seven, and from seven I go to 10. And so in 10 years I'm buying $10 million of property. Okay, that's cool. How much money can I make when I do this? And it's a staggering amount of money. I don't think there's a business on earth that is as scalable as multifamily if you simply look at the numbers. I mean, you can get to making $700,000 a year in 5 years, and that's really cool because now I can start planning. I can look, oh my gosh, that's a lot of money. Maybe I should actually reinvest it. Maybe I should hire someone. Or maybe I should invest in marketing so I can raise more capital, right? Maybe I should reinvest a portion of that. How should I do that? What is the best practice of doing that? Then once people realize the opportunity, they go, oh my gosh, how am I going to raise all this money? How am I going to raise enough money to buy 3 million, 5 million, 10 million? And they flail about with that. They're like, oh, I'm going to put up a website, but that website doesn't raise money. I know. I'll go on social media. Well, I got some bunch of followers, but no one wire me money. That's not working. They're like, daggone it. I'll hire an agency. And the agency doesn't understand raising capital, so they flail about and raise a little money, but I'm not raising $2 million I need per year to buy to $5 million. And so they flail around online trying to raise capital. And there's best practices. If you look at elite syndicators and how they scaled, how they plan, how they execute, how to do the marketing, it's already been done before. So, people who have come through a program and do a deal, that's awesome. We pat them on the back going, good job, right? Now you can become full-time, good for you. Now let's get to work, right? Because now we're going to sit you down and we're going to paint a vision, but we're going to create a plan. But then we also need to put something in place, systems and people, so you can execute that plan.
I think a lot of people, when they start hearing the word syndication, when you're newer, they get intimidated. And it's not that hard. We've done a good number of them. Can you kind of walk us through how easy it actually is?
Syndication is a fancy term that simply says raising money for OPM, other people's money, right? So maybe I should just call it OPM, buying real estate with other people's money. That's what a syndication is.
Michael, not to be, but I have a company called OPM. It was my
Love
first property in Texas, but it wasn't other people's money. We were in the office. They go, we need a name for the company. And they go, who's funding this? You go, we are. And it's, oh, you're using your personal money. I go, yeah, our personal money. That's where that came from, though. We weren't smart enough to think about other people's money.
Funny. That's funny.
Sometimes you really got to look in the mirror and go, Jesus, Joe. All right. So syndication. So how do I, the process? Do I have to find an attorney? If I want to do my syndication, I want to really take off and grow. I got to find an attorney. Can I get the documents online? Do I call you? What do I do?
So syndication is, again, it's using other people's money, but syndication also implies a certain legal structure that normally when you raise money, there's the general partners who are the active operators, and then the limited partners who are the investors. But at the end of the day, the legal structure is really set by the SEC attorney, right? So the quote hard part is really raising money. I can raise money and not have a syndication, meaning that I don't have GPs and LPs. I can raise money with 5 buddies of mine, and we're all equal partners. I do all the work, and they're basically silent partners. And I don't need legal documents because we're all voting partners. Now, my first deal was done that way as well. So is it a syndication? I would argue yes, but legally it's not. It's simply a partnership or whatever you want to call it.
Mhm.
So syndication is really kind of a fancy term with a structure behind it, but it's again, it's a who, not how, right? You could spend 6 years learning SEC law. To what end? You hire an SEC attorney, they're going to sit you down and go, what do you want to do? I want to buy a building. Okay. Are you using other people's money? Yes. Okay, cool. So you're gonna have GPs and LPs. What do you want the split to be? Well, you got to go into your, in your financial model and determine the split. Okay, is there a preferred? Is there what is the exit? Blah blah. They're gonna ask you all these questions, all business related questions, and then they go off and do a bunch of stuff. And they come back with a bunch of legal documents that are disclosures, and your investors sign it, and then they wire you the money. That's it's really at the end of the day, that's really what it is. So people get a lot of, they get very anxious about this idea of all these legal documents, but really at the end of the day, that's what your attorney's for. And of course, the cost of an attorney is built into the deal itself.
Yeah. It's not that expensive. I think ours was it was just it was a few $1,000s. I think it was around 10 or so. That's a while ago. Don't hold me to that now though. I mean, that's been like 15 years ago. I haven't syndicated for a while. Um, so where did you go? When you did your first syndication, where did you go to start raising your money? Just friends and family? Just start knocking on doors?
Well, at the time, I started with my friends and family. I had flipped at the time probably like 20 houses. So I was actually borrowing money from people, 6-month hold, 12% interest. And I went to them to, buy a $450,000 12 unit in Washington, D.C., and none of them wanted to invest. I'm like, what is going on here? First of all, it was a $50,000 minimum, and my minimum on the house flip was 25.
Right.
But they were used to getting their money back in 6 months. So a 5-year hold, they're like, first of all, I don't have 50. I have 25. Okay, I'm not giving you 50. And I don't really like giving you the money for 5 years. It was incompatible. And so I really, really struggled with raising money for that first deal because of that. It probably would have been a lot easier if I'd gone out, right away with that. And so, but here's the thing: is you got to start with your people you already know. You got to start there because those are the people. Who else are you going to start with? But the thing is that people like, oh, I don't, I mean, I know 14 people, and then I'll exhaust my network. Really? What about asking for referrals? Like if you're an agent, like aren't you taught to always ask for at least one referral? Hey, is your neighbor or friend who would like to sell their house maybe next year or maybe that? So it's all about referrals. If you on average get a one referral for every person you speak to, you never run out of anyone to speak to. So 101 networking not 101 is to always get one referral. Now there's other things you can do like networking and stuff like that. But at the end of the day, get some referrals.
Yep.
And don't think someone doesn't have money or don't think that someone has money because you'll be surprised the neighbor next door who always walks around in the Gucci stuff and buys stuff. The reason he's got no money is because he spends it all. Meanwhile, the grandma next door is the millionaire next door who, doesn't appear to have any money at all, and she's got $1 million stashed away. And a lot of people have monies in their IRAs, and that's a huge treasure trove. And most people don't even know they can use it to buy real estate.
Did you have to sweeten the deal on your first one for the investors? I mean, I'm sure you're not. Are you paying the same returns as you did back then, or have you adjusted your returns?
No, it's about the same. It might have
Is
been
it?
maybe a little lower back then. It really depends on who your investors are, right? Because if you're doing friends and family, like you tell them, I'm going to give you a 10% return on money or 13% return, they're like, oh, that's amazing. That's really cool, right? Because they're getting a 7% return on whatever they're invested in right now,
Right.
right? And so as your investors become more sophisticated, they will want a higher return because they're looking at more
Right.
deals. So they
Right.
start comparing your deal against this other deal. And so over time, the returns should go up. And typically, returns are between 15 and 18% average annual return currently with a 5-6% cash on cash. And that's really amazing. But the thing that's really amazing about it is the tax advantages, right? So that's very unusual. It's not your normal 27, whatever, 28 year depreciation. We use something called cost segregation that allows you to accelerate that quite a bit. And so an investor might get cash flow, but actually show a taxable loss in their K1, which is crazy, which they can offset their passive income against their essentially passive losses. Now you got to pay the piper at one point at the end when you sell, okay, unless you do a 1031 exchange, for example. Now that's really cool because it allows you to kick the can further down the road and reset the tax basis if you keep it in real estate and keep trading up, which a lot of investors do. Therefore, if you play your cards right, unless you need the money out, you can keep growing that money tax free, which allows you to really accelerate the wealth building process.
How often do you get that? It's a lot of people don't think about that. Is if I just exchange it, I could just keep this ball rolling. Is it a conversation you have with investors right off the bat, or is that as you're going down the road, you say, "Listen, we'd like to exchange this. Would you want to go? Would you want to be willing to exchange?"
Yeah, so there's a exchange in and an exchange out. So exchange in, because there's more legal fees exchanging in, typically the investment minimum is at least $500,000 or $1 million typically because it'll cost you legal fees, but allows you to basically 1031 exchange in. So you have some other property or you have a rental property in San Francisco, and you want to exchange out of that, you can into essentially a syndication. And at the end, when there's an exit, the investor has the ability to 1031 exchange again if they want. You don't have to exchange in. So in other words, you can come
Right.
in just with cash, and at the end, you can then either get your money back and pay taxes, or you can exchange into the next property. So yeah, we have different options going in and out.
Beautiful. It's a great way to do it. Where are you guys finding debt right now, if you don't mind me asking?
I mean, we're finding debt in the same places we were before. It's just
You
the
are.
terms are, yeah, the terms are a bit different. There's less leverage, but debt is still available, plentiful, like normally a lower leverage though than it was say 2.5 years ago. That has changed considerably, and this is why the risk 2.5 years ago in the multifamily space was much higher for what we talked about earlier than now, where the leverage actually is a lot lower. But even over the last 6 months, that started to change. So 2.5 years ago, you're getting 80% loan to cost, meaning 80% of the purchase price, 80% of fees, 80% of construction. Wild. Now, 6, 9 months ago, we were getting 65% loan to value, which is only the purchase price, no construction. And now we're up to like 75%. But again, only on the purchase price. There's no construction loans right now. So, and the reason this is increasing is because of the stabilization of the interest rates. Interest rates don't have to go down. Okay, they just have to stay about the same because this volatility is what creates risk in the lender's mind. So even if they stay at 7%, it still creates stability just at a higher place. Therefore, while you're still paying higher interest rates, you're getting higher leverage. And therefore, because of that one fact, prices will go up because leverage will go up.
The investors, I know the multifamily is great to be getting started investing in right now, but is it easier now than it was last year to go out and raise money from investors?
No, it's harder.
It is harder.
Yeah.
It is. Okay. Yeah, with this volatility, they just don't want to deal with it.
It's harder because two reasons. One, there's a good number of people who have been investing in multifamily and they, got burnt.
Yeah.
And the distributions have stopped. Sometimes there's been capital calls. Sometimes there's been 100% loss, right? And so these are investors who are like, "Oh, that is bad," right? And then there's news. The news is another place where people look at, they look at the office space, they look at multifamily, and they go, "Ooh, that's bad, really bad," right? But what you have to recognize is that the sophisticated investor, while they may have gotten burned, recognize why they got burned. And so a number of them are coming back because of that. It's the same thing like with the office space, right? There's blood in the streets in the office space, but recently Wall Street Journal talked about a private equity fund bringing billions to buy up office space on the cheap. Why? I don't know, but they're seeing something and they're not stupid, right? So they're seeing some kind of opportunity and they're going to back up the truck. And so the sophisticated investor is going, okay, there's blood in the streets. There's still some left. People aren't really getting into it. I sense an opportunity of some sort. And they start asking questions. They're looking behind and going, okay, what happened? Let me understand exactly what happened. Why did I get burned? And they realize exactly what happened. And it's a one-time event that is not likely to repeat itself probably in the medium term or even long term. Who knows? They understand exactly what happened. If you look at the outlook, it's not likely to happen again. And so therefore, like, I'm buying stuff at a lower price, lower leverage, and so it seems like an opportunity. I'm buying stuff 40% at discounts and stuff that was there before, yet the fundamentals are still strong. And so they're starting to come back in because they're asking questions.
I talked to, I think we both can agree that, money was really cheap and a lot of deals were happening in well, across all asset classes that probably shouldn't have been being done. And, we have a commercial mortgage company, Icon Capital Advisors. And some of the deals we're seeing, we're like, there's no way this should be getting done. And it did. It still did. There's a group that we knew of, and they were buying a property a month, sometimes two and three properties a month. And, they were just, it didn't make sense, but they were still buying. I don't know if their word is SEC was starting to check into them mid last year. But it sounded like there's some funky stuff going on. So I think there's going to be, are you thinking some of those deals are going to be coming back on the market that were really jacked up in the beginning? Are you seeing that right now?
Yeah, so I was expecting a little bit more to come back in foreclosures, and very little has come back in
A lot.
foreclosures. It's they're really being worked out on the back end.
Yeah.
They're being worked out either with the lender itself, or they're being worked out with workout groups, pref equity groups,
Yep.
or other GPs coming in, taking over the deal, essentially. So we're seeing a lot of that behind the scenes stuff going on. So yeah, we're not seeing nearly as much of stress as I would have hoped. However, it has normalized the market a lot. I mean, 2.5 years ago, the height of the market was March of 22, where there was multiple bids above asking, certainly non-refundable deposits, and that's not happening right now. It's kind of nice. You don't have to come up with non-refundable deposit on day one, and because there's not a lot of people, buying as much as they were. So to me, the market's much more balanced right now.
Yeah. Back to the office space, we're seeing, and there was an article this morning about it, the number of office buildings that are being converted to residential is really shot up. And so cities are really working with these developers to make it happen, to get them the office off the market. I know we're running a little long on time, but I kind of want to touch on fund of funds. Do you guys use fund of funds?
We do.
Can you talk us about that process, please?
Yeah, so fund of funds is a way to bring additional capital into a deal, into a syndication. So the money really is raised directly from private individuals right into the investment itself, but there's also room for fund managers. Now, in the olden days, they used to be called co-GPs or capital raisers. What would happen is that people would raise money and they would bring it into the partnership and they become essentially a GP in the deal, but then they never show up for any asset management calls. They never visit the property, and they're really not active members, which is basically just raising capital without a brokerage license, and that is illegal. And so the SEC has cracked down on that quite a bit. It's an illegal way to raise money. And a much safer way to do that is by creating your own fund. Now it's a little bit more involved, but not really that much more. So instead of raising money into the deal itself, you raise money into your own fund. So you have your own SEC attorney, they create your own legal docs, and you are raising money into your own fund, right? So let's say you're raising $1 million from your investors, and then you write a single check into the deal itself. And for that, because you're a large check writer, you get preferred terms. And that preferred terms allows you to give your investors about the same return as if someone invested directly with the deal itself. And because you're getting preferred return, it allows you to make money on that. So it's a legal way to raise capital, but also it's a great way to build a business. If you want to raise capital rather than operating multifamily or operating mobile home parks or operating anything at all, you become a fund manager. It's almost like a private equity firm that you become, and it's a great career path for a number of people.
Is when you have to raise that money and you raise a boatload of it, you got to spend that money. And so, you got to be finding the deals. There's puts a little pressure on you, doesn't it?
Well, these are not blind funds. They can be, but
Yeah.
typically they're still deal specific. Yeah, so these are just deal specific funds. So
Deal
let's say we
specific.
have a
Okay.
deal. We have a deal now under contract, and we go out to our fund manager partners going, "Hey, we got a deal under contract. We got 6 weeks to raise this money. Go." And so they're all raising money for a specific deal, right? Now you can do it with a blind fund. Blind fund is a little more complicated. A blind fund means that you're actually raising money all the time, and you are likely to deploy it across multiple properties. It can be done. It's just investors don't prefer it as much because they don't know what you're going to invest in. So in other words, they may or may not like the particular deal. There are advantages of blind funds because it allows you to even out the fund. So if I, let's say I have five properties in there, one's sucking wind and one's crushing it, I can even out across the portfolio, right? So without one, the investors that are one and sucking wind are like, I'm not happy, and the other ones who are crushing are like, oh, this is great. Yeah, I don't want to suck wind and I don't want to crush it either. I want predictable returns. And so a blind fund can help with that. It's just harder to raise for that. But you can also raise money into a blind fund that does not involve you taking wires in. So in other words, you can raise money with commits. These are legally binding financial commitments. And let's say you have 12 months to do capital calls. So let's say you invest $100,000. I'm going to raise $10 million. Now I have a deal that requires $5 million, let's say. I then do a $5 million capital call, and my investors now have to wire me $50,000 each, whatever the case may be. So in other words, I am not paying a preferred return because that money is actually not sitting in a bank account. So there's some ways to address it. It's just not very common unless you have a much larger deal flow. So the blind funds is, in our little world, not as common unless you start getting a little more into the institutional realm.
Spot on. I want to go back to syndications. Can you walk us through I'm a syndicator, where you make money? I don't know we probably should have touched on that earlier, but it just dawned on me. So here we are. Where do I make money when I syndicate?
Yeah, it's amazing because it's really the only real estate strategy that pays you up front, during, and after. Rentals don't do it, flips don't do it. Really, no one else does it. So one of the biggest differences is this thing called an acquisition fee. Acquisition fee is paid to the GPs. We talked about the general partner, the operators. And the GPs do all the work, and then the LPs, limited partners, bring in all the money. And typically there's a split, 70%, 70, 30, 70 going to the LPs, 30 going to the GPs, or 80-20 or some derivation thereof. And so the LPs put all the money in and don't have to do any work. They have limited liability. And in return, they get a good return on their money, cash and cash return, and tax benefits. Cool. The GPs get sweat equity. So let's say it's 30% sweat equity in the deal. They also get fees that are disclosed and normal, but typically acquisition fees are around 2 to 3% of the purchase price. So this is why syndications can be a very powerful tool to help people exit whatever they're doing. So if you're doing a $4 million deal, you and your partner, you're splitting a $120,000 acquisition fee. That's a meaningful number, allowing me to quit whatever I'm doing and potentially become full-time in this business and now invest in this full-time. You're also getting asset management fees for asset managing the property, and you're getting cash flow distributions. And then, 5 years when you exit, there's hopefully a profit at the end as well. So the idea is that you're stacking these on top of each other, right? So depending on how you're set up, you're doing one deal, in the first year, maybe you're doing two deals in the second year, and so on and so forth. You're stabilizing it, adding a property manager over on top of it, and then you're doing again and again, and you start basically creating multiple profit centers out of your portfolio.
Perfect. All right, Michael, what's next for you?
What's next for me? I think next for me is really just figuring out how to scale this thing a little bit more, right? Every time you scale this thing, we talked about stacking on top, and being mindful on how you scale, making sure that we have the right people on track, making sure our systems are strong enough, and kind of thinking 1 to 2 years ahead. If I'm going to do these deals, what are my operations going to look like? What do I need to do now so that I can handle this kind of portfolio? I can handle my investors. How do I continually raise more money on that end? So it's just I'm kind of fascinated by it. I think it is one of the more scalable businesses on the planet with real estate, and I can control a very large portfolio with a relatively small team. But I have to be smart about it, right? And we made some mistakes along the way. We could have grown a little smoother. It was difficult to foresee markets changing the way they did. And we have some bumps and bruises along the way, but at the same time, our operations are stronger. We have the ability to resolve conflicts and problems better together as a partnership. And so I think we'll come out of this stronger.
Amen. How do we get hold of you, Michael?
Yeah, if you want to learn more about syndications, we talked a lot about the lower multifamily, especially if you're coming from a single family house investing world. I have a free training class. It's 45 minutes long. It's called Apartments 101. And it's got apartments101.co/Joe. and get to the free course as well. If you're interested in investing passively, then we are at Nighthawk Equity, nighthawkequity.com. So two places to check us out. Maybe take that next step.
All right, Michael, thank you very much. I appreciate you taking the time today. And for those of you watching, if you could, please give us a like. And if you haven't done so, make sure you subscribe.